stop what you are doing right now. I need you to put down whatever you were reading, whatever chart you were watching, whatever headline you were half processing while you scrolled through your feed this morning. Because what I am about to walk you through today is not a price update. It is not a technical analysis video. It is not another breakdown of the Iran situation or the Fed descent or the dollar weakness story that every single precious metals channel on this platform covered yesterday. What I'm going to show you today is something that is hiding in plain sight inside a completely different industry, an industry that most silver investors have never thought about in connection with their metal, an industry that is spending money at a scale that has never existed before in human history, and an industry whose spending decisions, made in boardrooms in Seattle and Menlo Park and Redmond, are creating a silver demand signal so powerful, so structural, so impossible to reverse, that when the market finally prices it in, the number you are looking at on your screen right now is going to look like a rounding error. Today is Friday, May 1st, 2026. Asian guy here, and as I am recording this, silver is trading at $74 per ounce, up from the 3-week lows we touched earlier this week, recovering, bouncing, and every single financial media outlet that covered the bounce this morning gave you the same explanation: dollar weakness. Japan intervened in currency markets overnight. The yen moved sharply, the dollar index softened, and precious metals caught a bid. That is true. That happened. And it is also completely missing the actual story, because the dollar move explains today's bounce. It does not explain where silver is going over the next 12 to 18 months. It does not explain the structural demand shift that is building underneath this market right now, invisible to most investors because it is coming from a direction that nobody in the precious metals community is looking. And by the time this video ends, you are going to understand exactly why $74 is not a recovery price. It is a setup price. It is the price silver is at before the market wakes up to a demand story that changes the entire fundamental calculus of this metal. Let me show you the engine, because the price on your screen is the exhaust, and the engine is running at a level this market has never seen before. I want to start with a single number, and I want you to hold this number in your mind for the entire video, because everything I am about to explain flows directly from it. $715 billion. $715 billion. That is the combined capital expenditure committed by just 4 companies, Meta, Alphabet, Microsoft, and Amazon, for AI infrastructure spending. Not over a decade, not over 5 years, in the current fiscal cycle. And that number represents nearly double what those same 4 companies spent just 1 year ago, when the figure was $375 billion. Now, when you hear $715 billion in AI spending, your brain probably goes to semiconductors, to NVIDIA, to data centers, to cooling systems and power grids and fiber optic cables. And you would be right about all of those things. But there's one material that sits inside every single one of those infrastructure categories, a material that is non-substitutable, non-negotiable, and currently priced as though this demand wave does not exist. And that material is silver. Let me walk you through exactly how silver is embedded in the AI infrastructure build-out, because the connection is not obvious and it is not being discussed anywhere in the precious metals space right now. It is the single most important demand development in this market, and it is flying completely under the radar. Start with the semiconductors themselves. Every advanced chip, every GPU that NVIDIA ships to a hyperscaler data center, every custom AI accelerator that Google's TPU division designs, every edge inference chip that goes into an AI-enabled device is manufactured using a process that requires silver. Silver paste is used in the die attach process, the step where the chip is bonded to its substrate. Silver sintering, a more advanced version of the same process, is used in the highest performance chips because silver's thermal and electrical conductivity properties are unmatched by any other material at scale. The more powerful the chip, the more heat it generates. The more heat it generates, the more critical the thermal interface material becomes. And the thermal interface material that performs best at the power densities these AI chips are running at is silver-based. Now multiply that by the number of chips being manufactured to service $715 billion in AI Capex. The semiconductor content per dollar of AI infrastructure spending is higher than any previous technology build-out in history. These are not consumer electronics. These are not smartphones with a single mid-range processor. These are server racks running dozens of high-end GPUs simultaneously, each one with silver embedded in its manufacturing process, each one generating heat that requires silver-based thermal management. But the semiconductor story is only the beginning. Move up one level in the infrastructure stack to the printed circuit boards that connect those chips. Every PCB, every board inside every server, every switch, every storage array, and every AI data center being built right now uses silver in its conductive inks, its via fills, its surface finishes. The movement away from tin-based and copper-based finishes towards silver-based finishes in high-performance computing applications has been accelerating for years, driven by the simple physics of electrical resistance. Silver has the lowest electrical resistance of any metal. In a data center running at the power densities required for AI inference and training, the difference between silver-based and copper-based connections is not academic. It is measurable in performance and in heat generation. And performance is the only variable that matters when you are spending $715 billion to build the infrastructure that your entire business model depends on. Move up another level to the power systems. Every AI data center requires enormous amounts of power. We are talking about facilities that consume as much electricity as small cities. The photovoltaic solar installations being built to power those facilities. Because the energy cost of running AI at scale is forcing hyperscalers to build their own power generation capacity, use silver. Every solar cell, every panel, every junction. Silver paste applied to the surface of each cell to collect and conduct the electricity generated by photons hitting the silicon. No silver, no solar panel. No solar panel, no cost-effective power for the data center. No power, no AI. And this is where the demand story becomes recursive in a way that is almost breathtaking in its implications. The AI build-out requires solar power. Solar power requires silver. The AI companies are simultaneously the largest new source of silver industrial demand and the largest driver of solar deployment, which is itself one of the largest existing sources of silver industrial demand. You have a feedback loop here. AI demands power. Power demands solar. Solar demands silver. More AI means more power demand, means more solar, means more silver. The demand is self-reinforcing, and it is scaling at a rate that the silver market has never had to absorb before. Now, here's the question you should be asking right now. If this demand signal is so powerful, so structural, so obvious once you see it, why is silver at $74? Why has the market not already priced in the AI Capex demand wave? Why are we not already at $150 or $200 if the fundamentals are as compelling as I am describing? This is the most important question in precious metals investing right now, and the answer has three parts. The first part is timing. The $715 billion in AI Capex that Meta, Alphabet, Microsoft, and Amazon have committed is not all being spent today. It is being deployed over a multi-year build cycle. The demand for silver that flows from that spending does not hit the market in a single quarter. It builds, it compounds. The chip orders get placed. The fabs ramp production. The silver paste suppliers get purchase orders. The delivery schedules extend. And the physical silver required to fill those orders gets pulled from a supply chain that is already running at capacity from existing solar and electronics demand. The market is not pricing the full demand wave yet because the full demand wave has not arrived yet. But the purchase orders that will create that demand wave are already signed. The Capex commitments are already made. The building has already started. The silver demand is locked in. It just has not shown up in the spot price yet. The second part is awareness. The investors who move the silver price, the managed money funds trading COMEX futures, the institutional allocators making precious metals decisions, are not thinking about AI Capex as a silver demand driver. They are thinking about monetary policy. They are thinking about the dollar. They are thinking about safe haven flows and geopolitical risk and the Fed's rate path. All of those things matter. But they are missing the industrial demand revolution happening right underneath their models. The silver analysts at the bullion banks are updating their demand forecasts based on solar panel production data and traditional electronics consumption. They are not yet building AI infrastructure Capex into their supply-demand models in a meaningful way. When they do, and they will, because $715 billion is a number that eventually forces its way into every model, the demand revisions will be significant. And significant demand revisions in a commodity market create significant price moves. The third part is supply. And this is where the story gets genuinely alarming for anyone who understands how mining works. Silver is not a primary metal. Approximately 70% of global silver production comes as a byproduct of mining other metals. copper, zinc, lead, gold. The silver does not get mined because someone decided to go mine silver. It gets produced as a consequence of mining something else. This means that silver supply cannot respond quickly to rising demand. You cannot simply decide to open more silver mines when the price rises. You have to wait for the economics of the primary metal to justify new mine development, then wait for the permitting process, then wait for the construction timeline, then wait for the ramp-up period. The total timeline from the decision to open a new mine to first silver production is typically 7 to 10 years. The demand wave from AI Capex is arriving now. The supply response cannot arrive for 7 to 10 years at the earliest. The gap between those two timelines is the most bullish supply-demand setup I have seen in this market in years. Now I need to zoom out and show you why the AI Capex demand signal is hitting at the single most powerful moment it possibly could. Because the timing of this industrial demand wave relative to the existing monetary demand drivers is not coincidental. It is the convergence that makes this move different from every previous silver rally in modern history. Every major silver bull market has been driven by one of two things: either monetary demand, investors buying silver as a safe haven, an inflation hedge, a dollar alternative, or industrial demand, manufacturers and fabricators pulling more silver into production than the mines can supply. In the 1970s bull run, it was almost entirely monetary. The dollar came off the gold standard, inflation went vertical, investors globally rotated into hard assets. In the 2010 to 2011 run, it was a combination, with the post-financial crisis monetary debasement intersecting with the early stages of the solar panel build-out, creating simultaneous monetary and industrial buying. What is happening right now, in May 2026, is something that has not happened before at this scale. You have the monetary drivers, dollar weakness, Fed credibility fracturing, central banks globally adding to gold and silver reserves, geopolitical risk from the Iran situation, inflation persistence that is structurally supported by energy supply disruption, all firing simultaneously. And on top of that monetary foundation, you now have the largest single industrial demand catalyst in the history of this metal arriving in the form of AI infrastructure capex that is doubling year over year. These two demand streams, monetary and industrial, do not just add together, they multiply. Because the investors who are buying silver for monetary reasons are buying from a market where the industrial users are simultaneously pulling supply. Monetary buyers see industrial buyers and read it as validation of the fundamental thesis, which attracts more monetary buying. Industrial users see the price rising and accelerate their hedging and physical accumulation, creating a procurement urgency that pulls more supply from a market that is already being tightened by monetary demand. The feedback loop between these two demand streams is the mechanism that creates the explosive, parabolic final phase of a commodity bull cycle. We are not in that phase yet, but look at the ingredients assembling in real time. The World Gold Council just confirmed that central banks increased their gold reserves in Q1 2026. Central bank accumulation at this scale historically precedes a repricing of the entire precious metals complex, including silver. Japan intervened in its own currency market overnight, which tells you that the dollar's managed decline is being accelerated by sovereign-level action from a G7 economy. The Fed is the most internally divided it has been since 1992, which tells you that policy credibility is eroding from the inside. And now, sitting on top of all of that monetary pressure, you have $715 billion in AI capex, creating a structural industrial demand wave for the exact same metal. The question is not whether these forces add up to a significantly higher silver price. That arithmetic is not controversial to anyone who has looked at the supply-demand data honestly. The question is only when the market prices it in. And markets, historically, price in demand revisions not gradually, but in sudden lurches when a critical mass of participants updates their models simultaneously. The catalyst for that simultaneous update could be an analyst report from a major bank revising silver demand forecasts upward for AI infrastructure. It could be a quarterly earnings call from a major silver consumer citing supply tightness. It could be a physical delivery bottleneck at a key refinery. It could be something nobody has predicted yet, but the conditions that make a sudden repricing possible are all in place right now. Let me come back to today specifically, because the way the financial media covered silver's bounce to $74 this morning tells you everything about how mispriced this market is right now. Every outlet that covered it said the same thing in slightly different words. Silver rallied on dollar weakness following Japan's currency intervention. That is accurate as far as it goes. The dollar softened. Precious metals caught a bid. Story over. Next segment. What none of them said What none of them are equipped to say, because their analysts are not cross-referencing AI infrastructure Capex data with silver supply-demand models, is that the dollar move was the trigger, but not the reason. The reason silver is at $74 and positioned for a move that goes dramatically higher is the structural supply-demand picture I've just walked you through. The dollar weakness just gave the market permission to move in the direction the fundamentals have been pointing for months. And here's what makes the mainstream narrative particularly dangerous for investors who rely on it. When you believe the bounce was caused by dollar weakness, you also believe the bounce reverses when the dollar recovers. You get nervous every time the dollar index ticks up. You sell into strength because you think the strength is borrowed, not fundamental. You miss the move because you are watching the wrong variable. When you understand that the dollar weakness was a catalyst, but the AI capex demand wave is the reason, when you understand that $715 billion in committed infrastructure spending creates silver demand that does not care what the dollar index does on any given Friday morning, you hold differently. You think about position sizing differently. You do not get shaken out by a dollar recovery because you know the underlying demand story has not changed. You do not panic on the overnight correction because you understand that corrections in a fundamentally driven bull market are buying opportunities, not exit signals. This is the single most valuable thing I can give you today. Not a price target, not a timeline, a framework for understanding why the price is where it is and where the real pressure is building. Because with the right framework, you make better decisions at every point in the cycle. You buy when others are confused, you hold when others are panicking, and you are positioned when the market finally catches up to what the data has been saying for months. Let me bring everything together because you need to leave this video with a clear picture of what the setup looks like from here. Silver is at $74. It has bounced from 3-week lows, driven by a combination of dollar weakness and what appears to be the early stages of managed money rebuilding its long exposure after the deleveraging event earlier this week. The monetary drivers, Fed credibility, central bank accumulation, dollar pressure, Iran geopolitical risk are all intact and in most cases intensifying. And now, sitting underneath all of that monetary pressure, like a second engine that has just started warming up, you have the AI Capex demand wave. $715 billion in committed spending from just 4 companies, doubling year over year. Embedding silver demand in semiconductor manufacturing, in PCB production, in solar power generation, in thermal management systems, across an infrastructure build-out that is not discretionary, not cyclical, not subject to cancellation because of a bad quarter. These companies have made multi-year capital commitments. The facilities are being built. The chips are being ordered. The silver is going to be needed. The supply response to this demand wave cannot arrive for 7 to 10 years at minimum, given the mining development timelines I described, which means the demand-supply gap is going to widen before it narrows. And in commodity markets, widening demand-supply gaps resolve in one direction. Price goes up until demand destruction occurs or until new supply arrives. At $74, we are nowhere near the demand destruction level for AI infrastructure silver. The marginal cost of silver as a percentage of the cost of building a data center or manufacturing a GPU is so small that the price would need to go to levels that seem extreme from today's perspective before it meaningfully affects purchasing decisions by the hyperscalers. And that is the final piece of the framework. Silver is not optional for the industries that are about to consume dramatically more of it. Solar panels need silver. Semiconductors need silver. AI data centers need power that needs solar that needs silver. You cannot substitute your way out of that demand chain. You cannot engineer around it on a 5-year timeline. The demand is locked in, and the supply is constrained, and the price is at $74. The investors who understand that today are the investors who will look back at this moment, this specific Friday in May 2026, when silver bounced to $74 on a dollar weakness story and the AI capex angle went completely unreported, and understand exactly why it was the moment that mattered. Not the top, not the expensive entry, the setup. The last checkpoint before the market catches up to what the data has been saying for months. The AI story in silver has not been priced in. It is not in the analyst models yet. It is not in the managed money positioning yet. It is not in the mainstream narrative yet. But it is in the capex commitments. It is in the purchase orders. It is in the construction timelines of the facilities that will consume the silver that the market has not yet decided to price. When the market decides, and it will, because $715 billion eventually forces its way into every model, the move does not drift higher. It gaps. It reprices. And the investor sitting at $74 watching it happen will either be positioned or they will be watching from the outside, wondering how they missed it. Do not miss it. This is Asian Guy. The AI Capex signal is the most important demand development in the silver market right now, and nobody in this space is talking about it yet. If this framework gave you something real today, a connection you had not made, a number you had not seen, a way of reading this market that the mainstream is not giving you, like this video and share it with one person in your life who holds silver and needs to understand what is actually driving it. The price is $74. The story behind it is worth far more than that.